Okay, structured products. So, I will come up, I took a ridiculously complicated slide and reduced it to an overly complicated slide. So I could spend 2 minutes and not talk about it for the next 43, because we're not teaching you how to build a structured product. Okay?
It's gonna take 60 seconds to get that ridiculous.
It's all right, no worries, because we still have people here. So I'm gonna let everybody introduce themselves, but I just want to point out that we have sort of rules on our panel that and kind of cover all bases. Let me start online. We have
Lane?
Lane. She told me she dialed in, so
She's in.
so just get her up.
Get her on.
Hello. To be in.
She is.
I'll get you here. 1 second.
So I'm gonna let everybody introduce themselves, but I just wanted to point something out because we have this sort of balanced panel here. So
There she is.
Ling is on the rates desk at State Street Bank. Okay, she doesn't do structured products, but if I get the diagram, I'm gonna point out why that's very relevant to the conversation. Okay. Two, Herman, more recently departed allocator to hedge funds, and hedge funds are big players in structured funds. Okay, so an investor. Okay, Anthony runs a fund, hedge fund. Want to call it a hedge fund? Not a hedge fund? I don't know. It's up to him. Doesn't matter. Hedge fund's not a thing anyway. It's just a fee structure. So his structured products have a diagram, but he does it very differently than a diagram, except he's playing in the same sandbox. So we're gonna let him talk about it. So when we get to that, okay. What I don't want to do is get super down in the weeds because we're not going to be here for 3 hours. Let me let everybody introduce themselves first, and then maybe we'll have this gobbledygook on the screen. Anthony, go first.
Yeah, thank you very much. I'm Anthony Dwick. I'm a portfolio manager with Anchor Investment. We run portfolios of structured corporate credits, and we take credit default risk on portfolios of 80 to 100 corporates, typically looking to generate mid-teen returns.
So I recently, as Andrew mentioned, I left a fund called Titan Advisors about 1.5 years ago to start my own business, helping hedge funds raise capital, but also working with some of the large multi-strats like Millennium and so forth to secure senior portfolio managers, which is the hardest thing for them to do these days.
Yeah, a lot of competition.
Yeah.
Lane?
Hi, I run the global rate strategy for the investment portfolio for State Street. We have about 100 billion portfolio, mostly in global rates and mortgages. So my team look after global rates, focus a lot on obviously the Fed, the US rates market, Eurozone and sterling, as well as Australia and Canada. So has always been interesting the last few years. So Trump is making it even more interesting. Happy to be here. Thank you.
And to Ling's point, we're not talking about junk bonds. We're not talking about, these are all kinds. They are floating rate, in some ways secured loans. And you'll see, there's a list, okay? So, because people play in slightly different areas, but all the securitizations that we're talking about at least are that. They're not super low grade, distressed, nothing of the sort, okay, to do that. So, okay.
Which medium and which email did you use?
I sent it to your WhatsApp.
There we go. Okay.
Mark Satter.
I'll find it.
Okay. So me, it's my 40th year investing. I spent 20 years in a captive group of Swiss family offices. I had 5 years trading commodities, stocks, options, futures, basically anything that moved. The families invested in the hedge fund lifted me out, and I ran a hedge fund and 3 venture capital funds for them. Venture capital, and I was a tech guy and investing in Dell a year out of the garage and kept getting tech deals. So we did very well at that. 2000 and three, the family office groups broke up. Had they wouldn't even let me bring Americans, but for venture, I had American investors. But anyway, so I left that, and it's just a coincidence, but I went to State Street. And I was a guy that didn't wear suits, no title, no nothing, never heard of me. And so they needed somebody like that because they were starting a fund of hedge funds, and they didn't know anything about it. And I had a plan that I'd worked on for our family office group, and they said, just come do it here. So I basically built, designed, and ran for 13 years State Street's global fund of hedge funds. It was very successful from many points of view. And it was run very differently than an institution because you had a guy who'd never been around. But they let me do my thing. And it's like having a startup with State Street Bank's footprint. Ling's in an office tower in Canary Wharf that says State Street on it, So it was kind of a really interesting situation. So I hired 140 hedge funds and all over the world and in every asset class. And then they didn't want to be in it. We sold my group to InvestCorp. I spent 2 years there. And when I left in 2017, because I'm coming full circle with this, 9.5% of the portfolio was CLO, triple B, double B derivatives, which is part of what comes out of structured products. So that was 9 years ago. Full circle to today, one of our family office projects is working with a hedge fund, existing credit hedge fund. They want to be in the structured product business. So we're putting the equity portion together to help them launch they're already well established, but they want to add that on. So full circle, I'm actually doing all this kind of stuff today. So my point is that there might be questions that I might be the one answering them if somebody else isn't more appropriate to that. So with that said, okay, so we'll get back to that in a minute. So let's start with a couple of things from the sort of investor side. Because you got two guys, somebody that would invest in him and somebody that runs it. So and Len's not specifically involved in structured products. So we'll get to that in a second. So Herman, from the perspective of an investor, and we had very diverse portfolios, we could invest in anything, right? So because he recently we knew each other from the same business. So what is the attraction? Just from an investor point of view, what's the attraction of structured products in general?
So when you think about,
and these mics are not, so
yeah,
you have to kind of.
So when you think about securitization, you can tranche it into different tranches, right? You talk about AAA, AA's, all the way down to triple
Let me
B.
stop you for 1 second.
Yeah.
I want to take 2 minutes, and then if there's questions at the end, it's fine. I'm gonna take 2 minutes, so maybe everybody knows what they're talking about. Okay, so you've got to draw a line down the middle. These are all the assets. They're all loans. Senior loans, middle market loans, mortgages. Remember the mortgage crisis? Securitizations, but also other stuff, student loans, whatever. There. Okay, so you want to create one. You need the equity. That's what I'm talking about. Now you build something called a warehouse, which is basically a big pile of all these assets, and then a bank. And there are different grades, and it's a process. And then the bank securitizes it into these notes. So you're buying assets here, and you're selling notes over here. So the AAA is, and these are insurance companies and foreign banks, pensions, very low risk, very low return. Why would an insurance company do it? Because they're in the insurance business. They're writing policies, and the regulators want very safe assets. So they buy this stuff. We wouldn't want it, I can tell you. So then you get down to the sort of safer but higher returns somewhere in the middle. And as I said, you got, small triple B, double B, got hedge funds in here. And then the equity part, which is what I was also discussing, is private equity and managers themselves, the specialist funds, wealth managers off-take it, and private investors like us. So you got these two sides. Here's the structured product on the right, and here's all the assets on the left. You got borrowers like United Airlines, Chobani, Uber. They're not people you never heard of. These are public companies. And then the underwriters these are all big banks you you heard of. And then the manager builds a warehouse and goes and cherry picks. They do a lot of fundamental analysis and they build a portfolio that's appropriate. And it's well, there's huge institutions, there's hedge funds and there's boutiques, but they're trying to build an optimized portfolio. So to securitize. So that's that. And unless there's questions later, I'm not talking about it. So anyway, so Herman,
Okay,
back to the attraction.
got it.
And by the way, I pulled this from a CLO thing and tried to take it out. It doesn't matter. You securitize any of these assets, the process is the same. Except.
Got it.
Except for the- Go ahead. That's the
So
end of my
Andrew
speech.
actually has me beat in tenure in this business, but I've been in the business for 35 years. And I actually started. Ja, hey Eddie, hey, leuk om je weer te zien. Moet eens een keertje voetballen. Heel lekker. So as you can tell, I'm Dutch. I graduated from med school in the Netherlands, and then I actually started in mergers and acquisitions at Salomon Brothers. So I've been in the business 35 years, and then I switched to government bond trading here in New York, and I sat 5 feet away from the mortgage department. So I know a lot of the people that you've probably read about in Liar's Poker, and many of them are actually my friends. But the point is that I've seen markets evolve over time, and back in the late 80s, when you talk about securitized products, it was basically residential mortgages that were backed by Fannie and Freddie, or the underlying collateral were Freddie Mac and Fannie Mae mortgages. Obviously today, there are, Dunkin' Donuts, anything where there's a cash flow, you can securitize it. In other words, you take those cash flows and you carve them up into different credit tranches. So someone that wants a safe tranche, they'll buy the AAA tranche, and then it goes all the way down to single Bs. Then you have the equity piece, which is like the nuclear component, which can blow up at any point in time, but the returns can be pretty substantial. I mean, it's true, right?
Yeah,
So,
well, yeah.
so ending with the word blow up, Anthony.
But the point, to answer your question, what's attractive is you can pick and choose the level of risk that you can take. And when we're talking about AAA, when you do stress testing on some of these tranches, you'll stress test it for long-term capital, you'll stress test it for the global financial crisis, for COVID, and you can see that these tranches barely move in some cases. And that gives people a lot of comfort. And some of the yields on this can be, fairly substantial over and above the risk-free rate, whether it's 10-year treasuries or
By the
whatever.
way, no AAA or single A has ever defaulted in the history of the business. But get down but it's not as risky as I think you pointed out to me.
I'm talking about the equity piece.
So even the equity piece, anyway, we'll get to that. Ling, so what is your point of view on all of these assets, that are in front of you and the stuff you look at and matters to you, and the stuff, of course, that's just a derivative of what you do?
Yeah, obviously, I'm no expert on structured credit, but I have been to a couple of crises, the subprime crisis. There are some senior AAA tranches marked down substantially. So the market volatility is definitely out there. Obviously, a lot of them eventually is money good. But I remember those times when you say money good from 100 to 82, it's a tough sell. But anyway, we've got lots of expert here. But I think this really stressed the fundamental analysis. At the end of the day, as Andy, you said, securitization is a process or a way of making a sausage in one way or another. But what goes into the ingredients, which is the asset side, which is the fundamental analysis, it's really, really important in a great macro environment, supportive central bank, stable policy, political or global, trade environment. You probably get a lot less volatility, and then you could have that steady return. But I think we're actually not in those environments anymore. So I think for each of the sector, first of all, I'll talk about my own sector, which it used to be central bank running the show for years. They were doing QE. It's quite predictable, but it's also very boring. In fact, that almost killed the macro hedge fund industry for over a decade. But what has happened after COVID is the rate environment has changed substantially with the inflation. Obviously, I don't have to rehash what happened the last couple of years. but it makes the market more interesting. You see a lot more, divergence of central bank policy, economic backdrop between Europe and US. We talked a lot about US exceptionalism last few years. Really, that story is still on up until only a few months ago. So a lot is supported by, very supportive, central bank policy, as well as the fiscal support during COVID, as well, very strong consumer, as of now. But I think the real changes over the last few months, literally, the uncertainty of the trade tariff discussion, and we're going to have very interesting information coming out in the next few hours. And I'm pretty sure of it. It's not going to be the end of it. I think it will be the start of a lot of uncertainty. So that means the fundamental analysis you have to do in terms of all these trade policy, and then correspondingly the reaction function to what the US does. For example, the fiscal spending in Europe, all that would have huge implication to not just the central bank, but also reaction function, the rate path, which is very important to all these asset class, but also the industry. Like what industry, maybe defense industry get, benefit from some the tremendous expense in the expansion in Europe. Just a few examples. So creates a lot of different impact. So I think from that point of view, to look at the each sector, and then to look at the various factor, how they impact the different sectors, that it would eventually affect the spreads of the different sectors. Did I go over time? Sorry.
Like, we'll talk about that.
Like, I have a question for you real quick. Can you just let everyone know, because I'm impressed by it, at least, like what you manage?
What's your day job?
We have a pretty large custodian business, so really, the State Street has a lot of, it's one of the biggest custodians. So we manage the assets side of the balance sheet, invest mostly in government bonds, swaps, interest rate position for the bank. So, within my sector, we have about 60 to 70 billion exposure, but mostly through central, my team look across all the central banks, what they do, the five major one, which we have the largest deposit, and then, what's the impact of that, and also the monetary, fiscal, political environment, and what's the impact to the economy, as well as inflation. So what does that mean to the 5 and 10 year, the longer end of the curve? So
when I was there, I worked in asset management. She works in corporate, so we didn't have the same jobs. But I was everybody's collaborative, even if it's a big place. So I know that at the time, maybe it's less so now, the balance sheet did have things like senior secured loans and some derivatives and some of the fixed income funds. And I know you're not in asset management, but do you follow that everything you talked about, the collateral effects on any of these? These are all floating rate instruments. Do you follow the relationship at all between them?
I used to work at SSGA up until 7 years ago, and I moved the bank side. So I know the SMN side of the business as well. But you're absolutely right. The investment portfolio used to be a predominant floating rate structured book, actually, of almost like 90%, up until I would say kind of, 2016, 17. But then because the CCAR, which is stress capital requirements from the Fed, State Street as one of the GSIP, one of the systematic important. So we actually shift the book mostly almost the other way around, 80% structured, 20% kind of rates product to 80% rates mortgages, rates, global rates, and plus US mortgages to like 20% structured product. Just the nature of the bank treasury book has changed a lot. Yes, I do feel that, I feel from my perspective, I sit next to the head of credit, and they look at structured credit very closely. And it is closely related to, the macro environment within that economy. If they look at Aussie, ABS or or RMBS, you know, it's a very different dynamic from, let's say, you know, for Eurozone or the UK buy-to-let, you know, sector. So I think the fundamental from a macro perspective and the specific fundamental analysis from the assets and the pools and the structure is very different, for example, from the ABS market in the US.
So just a last quick statement. What you're referring to was a change from 2016 to today? Is that what you were just saying?
Yeah, I think actually even more so, it's because there's a lot of the structured, you know, are from some of the aftermath of the subprime crisis, and we kind of, you know, that also along with the regulation change, it just you know, not just State Street, but almost all the U.S. bank book has become a lot more HQLA, just high quality liquid asset class, which means U.S. mortgages and treasuries and stuff.
I was there beginning through the crisis and after. No, so I wanted to have Ling talk more first, because this is the background against the other conversations, right? So she's sort of setting the stage for the asset classes and what you look at and the risks and that type of thing. So I cut Herman off when the thing came up on here. So we were just talking about, and you're just starting to talk about the advantages of investing in this type of thing, about being able to control where your risk and returns were. You just expand on it a little bit before we move to Anthony.
Yeah, no, of course. You know, the securitized products market is around 14 trillion, I think, if you include RMBS, CMBS, ABS, and you compare that to the treasury market, which is like 28 billion, so roughly double the size, and we know how much that has grown. So the market is large. What that means for managers like yours,
Well,
like your
fund.
fund,
He's a
specialist. What that means is that there's a lot of fish in the sea. There are a lot of sectors that you can look at, and if you're good and you're sector specialists, you can pick up bonds that are potentially undervalued, that are being mispriced. Actually, I'll give you a quick anecdote. My wife actually works in securitized products at Barclays, and my daughter actually it works at JP Morgan on the securitized product syndicate desk. So I sort of live this stuff at dinner time. It's just sort of in the family. But the point is, when you think about edge and you think about technology, and someone asks a question about, are you using AI are you adopting AI in terms of your process? You know, as an allocator, I was always looking for a manager that seemingly had some edge, right? So for example, I'll give you an anecdote. My son currently is doing some programming for this company called Neural Labs, which basically what they do is they do risk assessment for insurance companies, so flood and fire and things of that nature. And so he's doing this, the software that he's developing is looking at residential, real estate, CMBS, commercial across the country. And he's doing this image adoption where you can see the type of roof, the type of bricks, what the backyard looks like. It's super cool stuff. But what it means is, you know, my wife was talking about one of her clients that were looking at this bond, and it was trading at like 70 cents on the dollar. Meanwhile, they were talking about California, the floods, the fires. And what happens is when you get fire, the clay, the ground turns into clay, gets really hard, and the water flows over and you get floods, and it just precipitates more and more damage along the way. So what they were doing is they were basically throwing out all these zip codes in California because they were in California. Meanwhile, the company my son was working for was looking at a lot of these zip codes, and a lot of it was green. In other words, those properties were actually perfectly good. So the map that they're looking at was mostly green in these certain zip codes. What that means is if you're a manager and you have this type of technology and you have this edge where you can look at some of these bonds, and if they're trading 70 cents on the dollar, but you think there's going to be no defaults there because the property is perfectly fine, that's edge, right? You can pick up potentially 20, 30 cents on the dollar on these bonds. So it's things like that that we look for as allocators and managers.
And this is in the corporate world. Reinsurance is specialty finance, by the way, wasn't on the other panel, but it's one of the categories. So that's what
Picture
he's
that.
referring to. Yeah, so no, I haven't left him out. That's right. He's going else.
5 minutes left.
Yeah, it's right. No, it's right. So
I'll be quick.
So Anthony just, so if you take this he's playing in the same sandbox, but you could throw out my diagram. Am I correct? And, oh, and one thing, he's not paying me. When he put his chart up and the recovery values were 0 and 50, and you're talking about people, the recovery values are 50 to 85% on average, so don't put 0 on your
Right.
chart. Anyway.
I should have said that about the
So-
No,
equity.
no,
so
that's-
Anthony,
don't
he's
worry.
taken a different approach to accomplishing sort of the same thing? Please.
Yeah, thank you. So we at Ankara, we manage the equity tranche. So the key focus obviously is to avoid that tranche going nuclear, as you say.
As are we, so go-
Yeah, no, for sure.
I'm
And
not-
but we have quite a lot of flexibility and levers that allow us to do that. But by virtue of holding the equity, we have full control of the portfolio and the structure. So we decide, obviously, we do all the credit selection, and we deal in corporate credits. So to put numbers behind that, the universe is probably about 600 credits that we can choose from, and we need to have about 100 in our portfolio. So there's a lot to choose from, and that means that we can choose across the credit spectrum if we wanted to. We want it to be really risky, we'd go single B or double B, or you could go to double A if you want it to be secured. But typically we swim in the triple B and double B space, and that's proven to be very resilient to market stress.
That's investment grade.
Yeah, sorry. And then the other key, I guess, lever is that we can decide on the terms, and by terms, we decide on the maturity, for example, of the
Dial it in.
yes, exactly. So in time of uncertainty, like probably today, we try to go for shorter maturities, and maybe at peak, what we feel is peak default cycle, we'd go for longer maturities, simply to get more convexity to our product. And it's something that has worked out well for us. Between Ankara and its predecessor, that's 15 years of history. There's never been one of our equity tranches that has lost money. It's always been positive IRRs, and that's going through the financial crisis, the sovereign crisis, COVID.
pandemic.
Yes, yeah, everything. And I think it's down to it's because of our market, which is a bit peculiar. We can play with all those levers, basically.
But you're playing with the top 2 assets on my asset list. You're still playing with those assets.
Yes.
Those are senior secured.
No, it's not. It would be.
As if you're playing with it.
It would be.
Different.
Well,
Go ahead.
no, it would be the underlying would be a corporate unsecured bond.
Unsecured.
Yeah.
Okay.
Yeah, but
And what type of returns do you get for
meetings.
mid-teen?
Yeah, 14%.
So that's a pointed question, because you see this as all the traditional stuff. Anthony's doing it differently. What are the incremental, because you know all this. So what are the incremental advantages of doing it your way versus the traditional way?
So we do it in a, try not to be too technical, but we do it in a synthetic way.
I meant from an investment standpoint. So you talked about being able to dial in your duration. You can't do that here. It has to
Yeah.
be matched.
Yeah.
Right?
So
So your duration and what
yes.
are the other aspects, because we're not going to explain how you do it, but what are the other aspects that your way has an advantage over the traditional way?
Well, for example, you were talking about the warehousing. We don't need that. If we decide to price a portfolio today, it probably takes about a week to get the structure together.
Takes 6 months to build a warehouse, by the
Yeah.
way, and you need equity.
Yeah,
Go ahead.
we can also, and that's linked, we can also perfectly match our assets and liabilities when it comes to maturities. So if we decide to do a 3-year portfolio, we're going to have 100 credits in that portfolio with each of them with 3-year maturity of 3 years, because it's a synthetic product.
And the last thing is, I think that's different, if I get this right. The counterparties here are the funds that are securitized. Your counterparties are a little different, correct?
Yes, so we we structure our portfolios via banks, and there's in today's environment, there's 4 or 5 banks involved. That's JP Morgan, BNP, Citigroup, and Nomura. So we build a portfolio, and they help us put the portfolio together. And our counterparty, for example, in the last transaction was JP Morgan. So JP Morgan is our counterparty.
So, but the banks securitize those CLO notes and distribute them.
Yeah.
Okay, that part is there. The counterparty risk is still back on the CLO manager. In your case, they might sell off risk, but the ultimate counterparty is who?
Well,
It's the bank, right?
yeah.
Okay,
Yeah.
well, that's not clear to everybody here. It's different than this.
Yeah.
If the CLO fails, the bank is off the.
Yeah, no.
Not with you.
No.
Okay, that's important. It's important. Okay,
So questions?
Yeah.
On this set of esoteric subjects?
I might not get these vernaculars right, but our family office is really big into creating their own desk at the moment for medium term.
can you microphone? I can't.
Can you hear me now?
A little better, yeah.
Okay. So,
You stay.
anyways, there's a lot of movement that's happening in New York banking, especially. There's a lot of consolidation happening. So I don't know if you guys are seeing the same thing, but a lot of the derivatives and things are kind of moving offshore for a lot of international people. Could you guys give a little more light on what you are seeing? Because we've had to restructure our banking the last 30 days because of it and the tariffs.
So I'm gonna answer this from the bank guy, or I don't think Wayne has this, but so the difference is, and what Anthony does and what this does, the bank is a transactional part of this. This is not the bank balance sheet, except for some financing in the warehouse, which is very well covered. So the bank balance sheet is not what's.
So if you're a private entity, right? So I'm a family office, right, that has capital. We have our own desk, but we're talking about settlement, right? So a lot of the services that are happening
The
here
banks
in
do
York
bank
is no
service.
longer the last 30 days because of what's going on politically. So I wanna see what you guys are seeing too in the market.
So having done this for too long, what we've done in the past, we did with mortgages, change servicers. The portfolio stands by itself. You can change the servicer.
It's no longer US anymore, so where?
Is anyone else dealing with this issue?
Or have questions that are.
Particularly this, and how you're settling. Anyone? Anyone's cross border, you got one, Nadir?
Settlement is one thing, servicing
Hold on,
is a
sorry.
different thing, and I'm not really sure what type of product you're talking about specifically.
Say that again.
Settlement is one aspect.
Yeah.
And servicing, securitization is totally different, and so I'm not really sure specifically what you're referring to. But like a CLO note, you buy it, you have a custodian that's gonna keep it, you can have JP Morgan, State Street, DB, whatever, they'll be somewhere, you can be somewhere else. You can operate your fund from the Caymans, who cares? But it seems like you're referring to something else, you've been pushed away from your bank because presumably they didn't want to offer the service you were used to, and don't know what this reason is.
It's not only our bank, it is all the banks in New York. So a lot of them, because of what's going on in the atmosphere, is consolidating. So they're consolidating to their services and products. So all that business is going out of the United States now. So I didn't know if anybody else was having the same issues.
I still don't understand that. What do you mean by that? So
So I
if
think-
you're,
Yeah, it's sort of how you do banking. And I'm here. Well, one thing we're gonna do, and maybe it's because it's my birthday, I get to call audibles. Last time we were here, we called audible that we're taking a break. This audible is we're pushing on, because I feel a certain thing, I wanna do 2 more panels, and then we're gonna do breakouts. We're gonna do structured credit and public finance, fixed income, sorry. And one of the breakout rooms where the lunches were. We're gonna do real estate where there's coffee. We're gonna stay here on the private credit tracks, and then we're gonna get to private equity in a second. So we've got private credit and equity niches next. Supposed to happen at 3:45 with a 15-minute break. Now we're 5 minutes late. So I'm just gonna go straight into, we could pick this up, this question even, in the breakout if you could, and those who wanna do more, or somewhere, like you said, it's sort of falling through the cracks.
You just have one statement that might clear it up. Once this is securitized, this is a balance sheet that is away from the bank. The bank could go out of business, it wouldn't make any sense. That's what it's-
All right, so we're pushing on to the credit niches. Nidan, if you could put that on the screen. I know Eddie, you're on.
Come join our 361 firm community of investors and thought leaders. We have a lot of events created by the community as we collaborate on investments and philanthropic interests. Join us.